Good evening, ladies and gentlemen. This is Barry Norman on behalf of 23 traders, and welcome to a class on trend patterns and interpretations. Now, understanding trend patterns and understanding how to read a chart and then identifying trend patterns on a chart can help you make very successful trading decisions. Now, technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of a share or a security reflects all the information about it that can share, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in share prices. For example, a head and shoulders pattern, channels, triangles, and wedges. These are formations that we can see on the charts based on price movement. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occurs between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of the asset as the price breaks psychological barriers in the form of support and resistance lines. So basically, chart patterns are just patterns that appear in price movement on charts. There are numerous types of patterns, all named according to the shape that the price graph forms between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. When these patterns develop, it's telling the trader that there should be a specific market reaction. Whether it's a market reaction up or down, we don't know, but it tells us one is about to happen. And then when it does react, it tells us what we can then expect of that pattern. So the most common chart pattern that traders look for are called triangles. Triangles come in symmetrical triangles, ascending triangles, and descending triangles. Now that sounds like a lot, but it's really in the direction the triangle is going. As you see here on the left, a symmetrical triangle, the upper and the lower channels are an equal proportion or equal angles. In an ascending triangle, the support line is horizontal and the trend line is on an angle coming up to it. In the opposite, in a descending triangle, the support line or the resistance line, depending on which price is moving, is horizontal, and the trend angle then, or the price channel angle, then descends on it. But in all three cases, what is important is, number one, is to recognize the pattern, and we can all see triangles pretty easy, and recognize the action. Because what's happening, what this is telling you is the price is being forced into this ultimate channel here, this ultimate tight squeeze, and is going to have to react when it gets to this point in a certain fashion. And it's either going to break down or it's going to break up. So it is the congestion of price movement in the pattern. So a triangle is formed between converging support and resistance lines. A negative slope resistance line indicates a reducing level of profit taking or more uncertainty about the value of a security. With a positive sloping support line, the price levels are squeezed into a corner. Once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. So if it breaks out this way, and what we can expect is when it makes the breakout, for a short period of time, it's going to have some momentum behind it. So this would tell us when we recognize this pattern, we should be trading this asset going up. And in a short term, not for a long-term investment. So for binary options, it works very well to trade it in the next time frame. the next expiry, or when it breaks down, you would trade it to go down, because what it's telling you is, okay, the markets have now broken out. It's not telling you that the market's not going to come like this, go like that, and go like that. But at the moment, it has momentum. And because it is this pent-up momentum that either the bears or the bulls have now gathered the strength to break out, for that next short little while, it's going to have some momentum. So a breakout is one of the key things that traders look for and to make profit. And it's the momentum that is added to the price change in the direction of the breakout. Now, there are specific variations of triangles that can occur, namely ascending and descending. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. It's these two right here. Okay. So basically, remember, when price is moving up, okay, this would be your resistance line, and this would be your support line. When price is moving down, okay, this is your resistance line. So as you notice, in a downtrend, to form the triangle you have there, in an uptrend, you have the horizontal line here to support the channel or the development of the triangle. Now, an ascending triangle usually occurs as a continuation of a bullish trend, while a descending triangle usually occurs as a continuation of a bearish trend. You can see that in the price charts on the right-hand side. So here we have an uptrend, a slight uptrend, support underneath the uptrend line, horizontal support line. Descending triangle, price moving down, support line. Okay, ascending triangle, we have both them moving in together. So basically an ascending triangle has an angular support line and an angular trend line. I'm sorry, I'm having a little problem with my marker tonight, but we'll get it off here. Nope, it doesn't want to turn off. There we go. Okay, using triangles to trade. It is important to note that an ascending triangle can also be found in a downtrend. So the combination of the name of the triangle and the market trend is deceiving. Thus, the financial asset needs to test the resistance line twice and needs to test the resistance level twice, and the asset closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. So in other words, when you have the trend line, okay, to actually be a triangle, because you see these shapes forming, but they don't fit the rules. And if you don't follow the rules, then you're just blindly trading some type of a format. So let's go through this again. Okay, in an ascending triangle, okay, the trend is deceiving. The financial asset needs to test the resistance line. When price bounce up to this resistance line, bounce off of it at least twice. Okay. And the closing price needs to be higher than the previous close. So not only does it need to bounce up and test the resistance line, it needs to close higher in the next time frame than it did in the previous time frame. In other words, the closing price has to follow the rising trend. So you need twice to test the resistance line, and that the actual center of the triangle, when you're forced in here, will fit those rules, that the close has to be higher than the previous close. So once you have it testing this resistance line twice, and then the close is the higher than the previous close, you now have the final formation of your actual triangle. Okay. Now when we come to volume, when in ascending triangle, volume usually contracts. Although there are a few numbers and cases that show volume has not contracted. Volume is the number of shares or contracts being traded in a specific time. There's a relationship between the trend and volume. When the trend is moving in a specific direction and volume stays steady, it's supporting the trend. If volume increases while the trend is happening, means more and more traders are jumping into the market and supporting that trend. Okay. When volume contracts, it's telling you that the traders are getting indecisive. And when you're getting into the wedge of a triangle, the center of a triangle, you should be getting this drop in volume because the traders aren't sure where this is going to be, where it's going to be. So now you have 3 pieces of information to determine your triangle. So the distance between the rising trend line and the resistance level give us our projection, because this is going to give us a projection of where we can expect price to move. So at this point, if we get the breakout, okay, this breakout should be equal in the distance of the third side of the triangle. So if our resistance level had a level of 1 and our trend line had a level of 0.5, then our projected value would be 1.5. So we're expecting a 1.5 or an equal distance to what the width of this triangle was in an upward movement if it's a breakout up. Because from an ascending triangle, we are looking for it to regain its traction on the trend line. You're not looking to trade going down because you're not looking to trade against the trend. Now, besides triangles, you can also get the formation of what's called channels and rectangles. A rectangle is exactly what it sees. It's a channel develops when your support line is running horizontal and you have range trading, so your trend line is also running on a horizontal. A channel is formed between parallel support and resistance lines. This pattern can indicate This pattern usually indicates a relatively strong trend up or down, with the price staying within the lines until a breakout. A breakout from a channel indicates either a reversal in the trend or a change in the slope of the current trend. So you can get a breakout going up. Okay, and when you get that breakout, this one is a reversal of the trend, because as you see, price is moving in a downtrend. Now, these tops and bottoms are the peaks and valleys of price movement, and the support and resistance line are gathered by finding price points in common. And when you have this breakout, it's most likely telling you that there's a reversal happening. Channel's the same, rectangle's the same, except it is on two horizontal lines. Okay. Now we have up channels and down channels, similar to a channel. Okay, and then we have rectangle. Rectangle is a pattern formed between horizontal support and resistance lines, similar to a channel. Rectangles and channels are sometimes referred to as flags and pennants. Okay. Depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down. There's a lot of mouthful there. A bullish continuation channel down. Or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. only called a pennant because they look the same. They're forming a pennant like, you wave at a sports game. Then we go into wedges. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. However, where the support and resistance line in a triangle have one positive and one negative slope, the support and resistance line of wedge would both have a positive and a negative slope. Wedges with positive slopes are called rising wedges, and ones with negative slopes are called falling wedges. Okay, now all of this gets to be a lot to remember, but the fact is they're all, except for rectangles and for slopes, rectangles and channels, all of the ones that kind of form triangles. Okay, breakouts are breakouts. So whether it's a wedge or it's actually ascending or descending triangle, they do have slightly different variations. They have slightly different rules, about them. But visually, they all kind of look the same. And anytime you see price congesting into one of these patterns, it's telling you something. And a wedge and a triangle tell you basically the same thing. The most common wedges are found as breakouts in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. So here we have a falling wedge, so we're looking for a bullish breakout. Here we have a rising wedge, and we're looking for bearish. When we get the breakout, if you notice, okay, we have price moving in towards a downtrend. We form the wedge, and we have the breakout of the wedge, and then price moves into an uptrend. Here we have an uptrend. Price breaks out to the bottom, and it begins the beginnings of a downtrend. Then we have the head and shoulders. Head and shoulders is a lot more distinct. Head and shoulders is a very important pattern when it develops. And it takes a time to develop. Okay. And head and shoulders is exactly what it sounds like. It is two shoulders of equal height with a head formed in between. This is the head. These are the shoulders. But what you would see first is price moving up to the head, the shoulder, coming back down to what we actually, in this case, it is a support line, but it's also called what we call the neckline. It's bouncing off of that support line and coming back up here higher than the shoulder, coming back down to that resistance line, that support line, bouncing off of it and forming the next shoulder. When it comes back down to that resistance line, it's telling us we're about to get a breakout down. And this is historically based on the psychology of the markets. You actually have the exact inverted head and shoulders, which occurs in the opposite way, because this starts from an uptrend and then moves, and this is the pattern develops, and then it moves into a downtrend. This starts the opposite way with a downtrend, but forms, if you turn it upside down, it forms the same thing on a chart. And I don't know what's wrong with the system here, but it just doesn't seem to want to turn off my markers. The popular head and shoulders pattern is essentially a triple top, except that all of the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of the bearish pullback that should occur between the tops and the bottoms. And inverse head and shoulders is similar to that, except it's in the reverse. Now, there is a set of rules that go with a head and shoulder, and it will help you find your targets. Okay. And this is based on your neckline, your head, the top of your head, where it actually peaked at each, and where your shoulders began. The calculation is your target price is the neckline, which is the resistance line, minus the head minus the neck. So if we were to say, let's give the neckline here a rating of 1. Let's say the headline is 2, but it would actually be the price. You would look for the actual price that this was formed at, the head term was formed. You would actually look at the actual price that the neck formed. And what you would do is you would take the neckline, in this case, we said it's number 1 or $1 or whatever you want to call it. And so it was 1 minus the head. In this case, we said the head was 2 minus the neckline, which we already assigned the number 1. And this will give us the target price moving down. So we have 1 minus 2 minus 1. So 2 minus 1 is 1. 1 minus 1 gives us 0. And exact difference down would be 0. So if this was 2, this was 1 on a graph, this would have been 0. And this becomes our target price, or equal to the distance here of where we're expecting that asset to fall to. So the target price is when it breaks out is where you would set your target trade. It could fall much below that, but this is where we would set our target based on the formula for using this to make a trading decision. So if this was gold and gold, the neckline of gold was $1,200, happened to be at $1,200, it peaked at the head at $1,250. Okay. We would then set our target at what? Our target would be T equals 1,200 minus 1,250 minus 1,200, which would give us 1,150. So our target, if this would gold, would have been for gold to fall down to 1150 in its trend. And this is the target that we're looking for to set our take profit point as we enter. We would enter a price here, a trade here after we got the confirming candle, and we would take it to that target at 1150. So we could pick up, well, you wouldn't get in exactly 1,200. So say you got in 1175, 1180, and you traded it down to 1150, you would pick up $30 profit per ounce of gold. Same calculations happen in a inverse trend, except the trade's going up. Same numbers, it's just reversed. So we also have a multiple tops chart pattern occurs in an ongoing uptrend and indicates that the trend is nearing exhaustion. If the security repeatedly has difficulty surpassing a certain price point, a multiple top pattern will exist. And the bullish trend progresses. Okay, so here we have what's a double top. So price is moving up in an uptrend, hits this resistance line, bounces off of it, comes off to the support line, comes off to the resistance line, goes back up to the support line, and then falls back down and breaks through. So they look just like W's. They're double tops, and we also go on to the next step, which is a triple top, and the calculations are done exactly the same. It's your target is S, which is your support line, which would be the bottom of, see the double top here? Up, down, up, down. So our target would be T equals S, the support level. So say for gold, this was 1,200. And this is an actual number in reality because it's a number that appeared on the chart. The top would say was at 1,260. And then you just do your calculations. And this is where you set your target price moving down. It's just the opposite if you're coming off of a downtrend. and the calculations are just in the opposite direction. Okay, then you go to the very, very important one. The more complicated these are, the less times that they appear, and the more valid they are when they do appear. And that's a triple top and a triple bottom. This is when it hits those support and resistance 3 times. Okay, it's a W, or say it's 2 V's, or a W plus a V. Does the same exact thing, but when that happens a 3rd time, and then you have a breakout, that breakout is very, very vital and very important. And you still have the same formula. Okay, it's in this case, when you have a triple, the target is the support line minus the resistance line. Okay. So an important measure of the quality of a pattern is the trend that precedes it. It does not matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. In other words, if it's a short-term uptrend and it's not very steep and this pattern exists, you might get the breakout, but it's not going to be valid. If you have a very strong uptrend and it's been continuing for quite a while, the more likely these patterns will be very accurate in their decision. So in other words, here you can see the strong initial trend. It was moving up, then it down formed and formed the channel. Okay. Here you had a slightly weak uptrend and it just moved into this channel, but it also tells you that even though it breaks out, it might even not have the momentum to go that far, or it might not even have enough momentum to carry it forward. Okay. So the pattern is said to have broken out once it is either crossed the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. So in other words, if the price breaks out, if you're in an uptrend and the price breaks out towards up, it is considered a continuation. If it breaks out and goes downward, or the opposite direction of the trend, it is then considered a reversal pattern. So in other words, market's moving up, the breakout is up, continuation. Market is moving up, breakout is down, reversal. Same thing in the opposite direction if it's a downtrend moving into these. Now, there are 6 simple formats. You have falling wedges, bullish triangles, bullish pennants, rising wedges, bullish triangles, and bearish pennants. When you have these correctly, and in binary options, you don't set your stop loss and take profit points. But when you trade the simplified CFD and Forex on our platform, you do. And this will give you your specific entry level. It'll tell you where to take your stop loss and where to set your profit levels when you are trading. And each one of these helps you make those determinations. So you have retracements, reversals, continuations, and breakouts. Now also we have, so we talked about continuations and reversals, okay? And they are how the pattern moves in a chart. A pattern is just simply a series of data that repeats in a recognizable way. We don't want to overcomplicate it. We're just looking for something we can recognize. It can be identified in the history of an asset being evaluated or other assets with similar characteristics. Patterns often include the study of volume as well as price, because volume, as I said to you earlier, should support the movement. If you see a trend moving up or down, if the volume is consistent with that trend, and then you have a shift in volume, either stronger volume or lower volume. When volume falls, that means the market traders are leaving the market. When volume increases, they're supporting that move. Okay. And it's important to be able to look at that together. Now, the other thing is, a very good way to trade these patterns is to combine them with Fibonacci retracements. Because Fibonacci retracements will help you learn what level these prices should bounce back to, whether it's a 37, whether a 31, a 23, a 61, a 50% retracement level to help you predict levels. Okay. Because retracements are very, very important. So what exactly are retracements? They are price reversals that are produced temporarily within a larger movement. Their most important features, they do not last for long before price resumes its original direction. You need to know how to distinguish price retracements from the more serious and permanent reversals. So like you see here in this chart, we had price moving up at a steady uptrend. We had the swing low, we had a reversal, we had a retracement, and all it means is it was retracing where it had been. Okay. It hit a level here and then reversed and went back into its previous uptrend. Okay. This can be very good trading here. This could be a very good entry point here. And you combine these with specific tools, especially Fibonacci levels, to determine where these will be, what levels you should expect to have the recovery and the reaction. But you have to be able to determine what is a retracement and what is a trend reversal, because they are quite different. Trend reversal means you're moving into a new downtrend. The buyers have now been exhausted. The sellers are taking control of the market, and they're pushing price down. A retracement is just the buyers are easing back a wee little bit. They haven't lost control of the markets. So retracements are temporary price reversals that take place within a larger trend. The key here is that the price reversals are temporary and do not indicate a change in the larger trend. The importance of recognizing retracements. It is important to know how to distinguish a retracement from reversal. There are several key differences between the two that you should take into account when classifying a price movement. Now, Fibonacci retracements help you determine if you actually have a retracement and where these are. Now, Fibonacci numbers were developed by a mathematician in the 12th century, but they can be put on a chart very easy, and the significant levels are 61.8, 50, and 38.2. And these are measurements of where price would retrace itself based on the length of the previous trend. So in other words, if price was in an uptrend and the uptrend started here and ended here, your retracement levels would be here, 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 and here. This is 61.8% of the previous move. This is 50% of the previous move. This is 38.2, and this is an important one, but it's the 23.6 level of the prior previous move. Okay. So if we're in a retracement, we would expect price to come down here and then retrace. If it doesn't come here, one of these levels is where we would expect it to retrace. Because like I said, the bears have not taken domination of the market. The bulls are just resting here. Okay, and that is the biggest difference, because it is a short-term movement within a longer-term trend. Okay. So Fibonacci replacements were designed to forecast the scope of corrections when trends are prevalent. The most common retracement levels can be achieved at 61.8, 50, and 38.2. Now next month we have a class on Fibonacci retracements, and we'll teach you how to put them on charts. But this is why do they work, and why is it important to distinguish between retracements and reversals? This is because traders have to contend with difficult decisions whenever reversals occur. For instance, should they hold their position open, but the risk of a serious loss because the price is moving against them? Alternatively, when it's just a retracement, you would want to hold under your position because it's going to retrace and come back to where it was. Alternatively, they could sell at the first sign of a drop and then rebuy at a more favorable discount. However, then they risk the chance of losing larger gains if the price should suddenly surge back in its original direction. So common technical indicators that are used to monitor retracements are Fibonacci retracements, trend lines, and support and resistance lines. There are several key differences in distinguishing a temporary price change and a temporary price retracement from a long-term trend reversal. Reversals are defined as a change in the overall trend of the price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. So these are the difference. These are who's controlling the market and where price should go. And you have to learn how to see these. And you need to see these with taking other indicators in mind at the same time. Okay. So whenever a price reverses, most traders and investors are faced with a tough decision. Do they hold? Do they sell? Do they sell and rebuy? So they have to properly identify these. So you can have, in an overall trend, several retracements. Okay, but when price hits a swing high and then turns around and moves down, it's not a retracement. Then it becomes a downtrend. So you have to be able to identify what the difference is. Okay. So triangles help you identify, because remember, you have a triangle breakout that's a continuation and a triangle breakout that's a reversal. Okay, and these patterns will help you determine what to expect. Okay. And on that note, we're going to end this class, and we're going to pick up next month on, we have a class on support and resistance, so we can learn how to judge these breakouts and the levels. We also have a class on Fibonacci next month, and next month we have a whole new class on trading simplified Forex on the binary options platform, and we have a 1-hour class next month in trading ladder. And using ladder trading with patterns and breakouts can be very beneficial to making a lot of profit using ladders to determine where price should go to. So have a very good night now. Thank you very much for joining us, and thank you for being part of the 23 Traders family. Have a good evening now.